What if I told you that the most powerful tool for building wealth isn't a market secret, but something we all have? Time. Imagine starting to invest in 1985. You would live through terrifying crises, the Black Monday stock market crash, the dot-com bubble in 2000, and the global financial crisis of 2008. It sounds like a horror movie script, right? But the truth is, even after weathering all those storms, those who held firm and kept investing saw their wealth multiply extraordinarily. Think about this. A modest investment, something like $50 a month started at age 18, could have turned into more than $350,000 with an average annual return of 11%. This isn't magic. It's the power of compound interest working in your favor over time. And in this video, I'm going to show you the exact step-by-step process to put that power to work for you, even if you're starting from absolute zero. But before we go on, let me ask you a question. Have you ever stopped to think where your money will be 10, 20, or 40 years from now? Many people believe that investing is a complicated game, reserved only for math geniuses or those who were born rich. But what if I told you that the most powerful tool for building wealth is not a market secret, but something we all have? Time. Imagine starting to invest in 1985. You would live through terrifying crises, the Black Monday stock market crash, the dot-com bubble in 2000, and the global financial crisis of 2008. It sounds like a horror movie script, right? But the truth is, even after weathering all those storms, those who held firm and kept investing saw their wealth multiply extraordinarily. Think about this. A modest investment, something like $50 a month, started at age 18, could have turned into more than $350,000 with an average annual return of 11%. This isn't magic. It's the power of compound interest working in your favor over time. And in this video, I'm going to show you the exact step-by-step process to put that power to work for you, even if you're starting from absolute zero. Step 1. Build your emergency fund. In the world of finance, that foundation has a name: the emergency fund. I know the desire to see your money grow is strong, but skipping this step is like building a house on sand. Life is unpredictable. A car problem, an unexpected medical expense. Without a reserve, any unforeseen event could force you to sell your investments at the worst possible moment, turning a long-term plan into a loss. So the first goal is clear. Save the equivalent of 3 to 5 months of your living expenses. Keep this money in a safe and easily accessible place, like a high-yield savings account. Once this safety net is in place, then you are truly ready to take the next step and start investing for real. Step 2. Open an account with a good brokerage and explore the index fund options. The stock market can seem like a jungle full of complicated rules and confusing terms, but I'm here to tell you that investing doesn't need to be complicated. It all begins with a single step: opening an account with a reliable brokerage. Think of it as your gateway to the world of investing. Once inside, you'll have access to a wide range of assets from stocks and ETFs to bonds and mutual funds. It's like a buffet where you can choose the ingredients for your investment journey. Now let's talk about index funds. They are essentially baskets filled with shares of many different companies, offering you a quick and easy way to diversify your investments. Just imagine owning a little piece of thousands of companies with a single investment. It's like putting your money in a box of chocolates, but instead of just enjoying the taste, you're also building wealth. Step 3. Invest consistently, preferably by automating your contributions. When it comes to investing, consistency is the name of the game. It's not about how much you invest once in a while, but about making regular contributions that add up over time. This is especially important for those just starting out. If you are able to save $50 a month, for example, investing that amount consistently over the years can lead to substantial wealth. The key is to make this process automatic. Set up a system where a fixed amount is deducted from your bank account and invested on a regular basis, whether weekly, monthly, or quarterly. This way you eliminate the emotional factor, avoiding the temptation to invest large amounts when you feel lucky and chasing returns. In addition to the benefits of consistency, investing regularly allows you to take advantage of a powerful concept called cost averaging. In simple terms, it means buying a fixed amount of a particular investment at regular intervals, regardless of its price. Imagine you invest $50 every month in a particular fund. Some months you might buy more units when prices are low and fewer units when prices are high. Over time, this strategy smooths out the impact of price fluctuations, helping you get a better average price per unit. Step 4, and most importantly, start now. You know the old saying, the best time to plant a tree was 20 years ago. The second best time is now. Well, the same goes for investing. Starting early is one of the most powerful strategies for building wealth over time. When you start early, even with small amounts, you give your money the opportunity to grow exponentially thanks to compound interest. On the other hand, delaying your start date, even by a few years, can have a significant impact on your long-term results. To illustrate this, let's look at two hypothetical investors, Alice and Bob. Both are 20 years old and plan to invest $100 a month. However, Alice starts investing immediately, while Bob waits 5 years before starting. Assuming an average annual return of 8%, Alice will have accumulated around $440,000 by the time she's 65. Bob, on the other hand, would have amassed around $240,000, despite investing the same amount. The reason for this substantial difference is the power of compounding. During the 5 years Bob spent waiting, his potential earnings were significantly reduced. Had he started early like Alice, his investment returns would have been much higher. Therefore, no matter how small the amount may seem, don't wait to start your investment journey. The earlier you begin, the more favorable the odds will be in your favor. So with these 4 steps, you're well on your way to transforming your financial future. But remember, investing involves risks, and past performance is not indicative of future results. Diversification is key to managing risks, and it's crucial to stay informed and make adjustments to your investment strategy as needed. Don't be afraid to seek help from a financial advisor if you feel the need. Your journey towards financial freedom begins with a single step. Are you ready to take that step? And to continue your journey into the world of investing, I've got another video that might be just what you need. Click here and check it out. And if you like this video, give it a thumbs up. And don't forget to subscribe so you never miss out on our latest tips. Thanks for watching, and until next time, happy investing.